Welcome back to another deep dive. Today, we're tackling investment Sukuk. Our goal here is really to unpack what these unique financial instruments are, how they work, and maybe most importantly, what makes them different. And we'll be using Shari'ah Standard Number 17 on investment Sukuk as our guide.
Yeah, it's a really interesting area of finance. Quite specific rules and principles involved that really set it apart. We're going to try and connect the dots for you today. You know, definitions, the different kinds, what they mean in practice. Hopefully it'll be a bit of a shortcut to getting your head around what can seem like a pretty complex topic.
Okay, let's dive right in then. What exactly are investment Sukuk? Are we talking about something like a bond or maybe shares?
So the standard defines them as, let me get this right, equal value documents representing common shares in ownership of tangible assets, usufruct, or services in a specific project or investment activity. And what's really key here is when they're issued. It's after the money's collected, the subscription is closed, and crucially, after the funds are actually put to use for whatever the project is.
Ah, okay. So it's not just a promise, it's linked to something already happening. But you mentioned bonds and shares. Are they like those or deliberately different?
Well, that's what's fascinating. The standard goes out of its way to say what they are not. It explicitly states Sukuk are not shares in the way we think of joint stock companies. They're not standard financial papers, not units in investment funds.
Okay, so why draw that line so clearly? What's the core difference?
The core difference lies in what they represent. Sukuk represent a common shared ownership in specific assets or rights. Think tangible things or the right to use something or services. And fundamentally, this is probably the biggest point, they do not represent debt owed by the issuer.
No debt. Okay, that feels foundational.
Exactly. So unlike a bond where you're lending money and expect it back with interest, with Sukuk, you're a part owner. They're issued based on a specific underlying Sharia-compliant contract. Think leasing, partnerships, that sort of thing. And this contract dictates everything, the rights, the obligations, even how the Sukuk can be traded later on. And because you're an owner, you share in the profits, the gum, but you also proportionally bear the losses, the germ. It's genuine risk sharing.
That risk sharing, the not debt part, that really does sound like the core principle. What does that practically mean if someone's considering them?
It means you're stepping into a partnership role, not a lender role. Your return isn't fixed. It depends on how the underlying asset or project actually performs.
Right, and it sounds like there isn't just one type of Sukuk then. You mentioned different contracts.
Oh, absolutely not. It's not one size fits all. The standard covers a whole spectrum. Broadly, you've got Sukuk of ownership, things like Sukuk for leased assets, or Sukuk representing the right to use something, the usufruct, even the services. And then you have the contract-based Sukuk, and this is where it gets really diverse.
Okay.
You've got Murabaha Sukuk linked to cost-plus sales. Istisna, that's for manufacturing projects. Salam, which is like a forward purchase. Then Musharaka for partnerships. Mudaraba, where one party provides capital and the other manages it. Wakala for investment agency. Even really specific ones like Muzara for agricultural partnerships, Muzaka for irrigation, Mugarasa for planting trees. It's quite detailed.
Wow, okay. So the underlying contract really changes the whole game for the Sukuk holder.
Precisely. The relationship between the issuer and the holders is defined by that contract. It dictates their rights, their responsibilities, everything. Let's take an example. For Sukuk of leased assets.
Yeah, give us an example.
Okay, so with leased assets Sukuk, the issuer is basically the seller of the assets. And the people subscribing, the Sukuk holders, they're the buyers. The money they put in is the purchase price. So the holders jointly own the assets, they get the rental income, but they also bear the risk if the asset value drops, for instance.
Okay, so they're owners receiving rent. What about another type, say Mudaraba?
Right, Mudarab is different. Here, the issuer acts as the mudarib that's like the manager, entrepreneur running the project. The Sukuk holders, the subscribers, they are the Rab al-Mal, the capital providers. Their money is the capital for the venture. They own the underlying assets of the Mudaraba, and they get a pre-agreed share of the profit. But, and this is key, if there's a loss, they bear that loss because it was their capital at risk. The Mudarib, the manager, typically loses their effort, not capital, unless there's negligence.
So depending on the type, you could be a buyer, a partner, a capital provider, even, like you said, sharing in farm output with Musara.
Exactly. The issuer in Muzara could be the landowner, or maybe the farmer doing the work. The holders get a share of the actual produce. It shows the flexibility.
That diversity is incredible. What really stands out to you about all these different types and relationships?
For me, it's how deeply the Sharia principles shape the actual structure. It's not just, putting an Islamic label on something. The focus on tangible assets, on specific contracts, on genuine risk sharing. Yeah. It dictates the entire financial relationship. It connects finance directly to real economic activity.
So beyond the definitions and these varied types, the standard must also have some pretty strict rules about how you actually issue these sukuk to ensure that Sharia compliance.
Absolutely. The issuance process is tightly regulated. It's permissible, obviously, to issue sukuk based on these recognized Sharia contracts we've talked about. And you can securitize assets, tangible assets, usufruct services, by dividing them into these equal value sukuk shares. It's fine.
Okay, so securitizing assets is okay. What's not okay then?
What's crucially not permissible is securitizing debts that are just sitting in a ledger, basically IOUs, for the purpose of trading them. That's a really critical distinction in Sharia finance. You generally don't trade debt at anything other than face value, if at all. So creating securities just out of debt portfolios to trade them freely, that's generally a no-go.
Right, that connects back to the not debt principle again.
It does. It's all interconnected.
Yeah.
Now, when you issue sukuk, the prospectus, the offering document, has very specific requirements. It has to clearly spell out the underlying Sharia contract, make sure all its conditions are met, and not have any terms that contradict that contract.
Makes sense. What else needs to be in there?
A really vital point. The prospectus must commit to following Sharia principles throughout the life of the sukuk. And importantly, it must mandate having a Sharia board to supervise everything.
A Sharia board, so like independent oversight.
Exactly. They act as supervisors, ensuring the money raised is invested properly, according to Sharia, and that the profit and loss sharing happens correctly, proportionally for all holders. And here's another key takeaway for you, the listener. The issuer cannot guarantee the nominal value of the sukuk back to the holders.
Cannot guarantee the principal?
Correct. Nor can they guarantee a specific amount of profit. The only exception is if the issuer messes up, fraud, negligence, misconduct, then they can be held liable. But otherwise, no guarantees on principal or profit.
That's a powerful point about the no guarantee rule. It really underlines that genuine risk-sharing aspect, doesn't it?
It absolutely does. It's fundamental. It's what really separates sukuk from conventional bonds where principal repayment is the core promise. Now, interestingly, while the issuer can't guarantee, the standard does allow for a third party to voluntarily donate a guarantee.
Donate a guarantee. How does that work?
It means an independent entity could, out of goodwill, offer to cover losses, but it can't be a condition built into the structure or paid for by the sukuk holders indirectly. It has to be a separate, voluntary act, often covering negligence or default by the issuer. Other quick points on issuance. It's okay for an institution to promise beforehand to buy any unsold sukuk, but they can't charge a fee for that promise. Sukuk can have various maturities, short, long, even indefinite, depending on the project. And you can use Sharia-compliant ways to manage risk, like contributing to an Islamic insurance, takaful fund, to smooth out returns or cover certain risks, as long as the methods themselves are permissible.
Okay, so they're issued according to these rules. Then what? How do they behave in the market? Can you just buy and sell them like shares?
Good question. Trading is possible, but again with specific rules. The general principle is, yes, you can trade sukuk if they represent that common share in ownership, and this happens after the subscription is closed. The sukuk are actually allocated to holders, and the underlying investment activity has properly started.
So once the project is up and running, basically.
Pretty much. But then the specific rules depend heavily on what the sukuk actually represents the underlying asset or contract. It gets quite nuanced.
Ah, okay. So it's not a simple yes or no for trading.
Not at all.
Yeah.
Take sukuk of leased assets, for example. Since they represent ownership in tangible assets that are generating rent, those are generally tradable right from when they're issued, once the assets are owned, all the way to maturity. But if they're redeemed early or bought back by the issuer, it must be at the current market price, not the original face value.
Market price redemption. Got it. What about others, like those contract-based ones?
Right. This is where it gets interesting. Sukuk based on usufruct, benefits, or services about, their tradability can depend on whether the underlying asset or the service provider is specific or just described generally. If, say, a property is released and the sukuk then mainly represent the right to receive future rent, which is essentially a debt owed by the lessee, then the rules for trading debt might apply, which are restrictive.
Complex. What about something like istisna, the manufacturing ones?
Istisna sukuk are tradable if the money paid by holders has actually transformed into assets owned by them during the manufacturing process, like raw materials becoming work in progress. However, If the money was just used to pay someone else in a parallel istisna contract, or if the final manufactured item has already been delivered to the ultimate buyer, then what the sukuk represent might become closer to a debt or a receivable. In that case, trading them falls into the rules for trading debt.
So the stage of the project is critical for tradability.
Absolutely critical. Now, murabaha sukuk, the cost plus sale ones. Here's a really interesting distinction. They're not permissible to trade after the goods have been sold and delivered to the final buyer. Why? Because at that point, the sukuk mostly represent the debt owed by that buyer.
Okay.
But they're permissible to trade before that final sale happens. So after the issuer has bought the goods using the sukuk proceeds but before selling them on, at that stage, the sukuk holders still collectively own the actual commodity, so trading is allowed.
Wow, that's quite specific timing. What about salam sukuk, the forward purchase ones?
The loan sukuk are generally not permissible to trade at all. Because they represent a future delivery against a spot payment, it falls under rules preventing the sale of debt for debt, or trading something you don't yet possess in that specific way.
No trading for salam.
Okay.
And things like partnerships, musharaka, mudaraba.
Musharaka, mudaraba, and wakala for investment sukuk. These are generally tradable once a subscription is closed, sukuk allocated, and the actual activity and assets or usufruct is started. Because then you're trading a share in an active, ongoing venture with real assets.
And the agricultural ones, muzara,
Similar logic. Muzara and musaka sukuk can be traded after the activity begins if the sukuk holders are the landowners, because they own the primary asset. But if the sukuk holders represent the party providing the labor, they generally can't trade their sukuk until the produce actually appears and becomes tangible. Mugarasa sukuk for planting are usually tradable once the activity involving assets or usufruct is commenced.
So the tradability really isn't a blanket rule at all. It's intricately linked, moment by moment almost, to what the sukuk represents: tangible, asset, service, debt, future delivery.
You've got it. It shows how the Shari'ah principles aren't just front-loaded at issuance. They govern the entire life cycle, ensuring the instrument stays connected to the real economy and avoids prohibited speculation or debt trading.
And you mentioned redemption must be at market price for tradable sukuk.
Yes, that's the final piece on trading and redemption. While the issuer can promise to buy back tradable sukuk from the holders, maybe through periodic offers, that purchase commitment must be at the prevailing market price at the time of purchase. It cannot be a promise to buy back at the original nominal value.
Again, reinforcing that risk sharing and the absence of a fixed return or principal guarantee.
Exactly. It avoids turning the sukuk back into a debt instrument indirectly.
Well, this has been an incredible deep dive into investment sukuk. We've really seen how they're meticulously defined, structured, regulated, all flowing from these core Shari'ah principles.
Indeed. I think the key distinctions are crucial to grasp what they represent, ownership, not debt, and then the very specific conditions for how they're issued and, as we just discussed, how and when they can be traded. Understanding these details gives you, the listener, a much clearer picture of what makes this financial instrument unique and where it fits in the bigger world of finance.
So hopefully what this means for you listening in is that the next time sukuk pop up in the news or in investment discussions, you won't just know the name. You'll have a real sense of the intricate framework behind them, the principles they embody. That makes you truly well-informed.
And thinking about those trading conditions, it does raise an interesting question for the future, doesn't it? Given that some types like salam or murabaha after delivery have these strict trading limitations, how might that affect their liquidity compared to, say, conventional bonds or even other sukuk types? And what sort of creative Sharia-compliant solutions might the market develop down the line to address those potential liquidity considerations? Something to think about.